We're here to talk about the Silicon Valley real estate market conditions for the week ending July 25th, presented on Saturday morning, July 26th. These are the key chapters. Just an FYI, the handout is posted. It was posted for last week. The video did not get posted for last week. So if you ever want to get the data and I don't do a recorded presentation, you're welcome to go and do the handout. And that's in chapter 12 on what the URL is. So all you need to know is the green root URL, the date for Saturday, and the handout comes up. So with the letter H. Jump to the chapters, the timestamps are in the YouTube description below. Let's get into the first data slide. Here's a summary of the different micro markets. And basically inventory now is back to the level you'd expect it to be. All other conditions are slower or more favoring the buyer than they typically are based on the previous 10 years. But despite them favoring the buyers, and you come over and look at the current conditions are still fairly balanced to favoring the seller, depending on which one you're looking at. Here's the number of offers that have been accepted, and that's probably the key. We're lacking the number of offers that we should. We're running about somewhere around 75%, but we've been there for well over 2 years now, and there's been really no change. You can see that we've been tracing the blue line, which is the least you'd expect based on the previous 10 years. It's the 10 percentile. The gray line up here is the median, and the red is the 90, or the hottest you'd expect the market to be. Here now is a summary of the key indicators. Inventory. You can see that inventory had been going with a surplus. We're above the blue line, so you were higher number of inventory than the 90 percentile until 4 weeks ago. 4 weeks ago, it dipped down and it's been staying down. And this last week, it actually even got closer to normal. So we're only 2% more inventory now than we typically are. Typical is 29.29, and we're at 29.84. So very close to the normal number of active listings. So that's buyer's choice out there. Offers accepted in the past 5 weeks. You can see that it was 75%. It's still 75%. We're typically selling 2,600 homes. We're only selling 2,000 homes. So you're missing over 30% of the marketplace. Number of transactions is very similar to offers accepted, except it's the closings. You can see we started off at 84%. And we're now down to 73% of the level you'd expect it to be. The 73% is in line with the number of offers that are accepted, and the transactions lag behind by the length of the average escrow, which is going to be 3 to 6 weeks. Days unsold inventory is the supply-demand ratio, the seller-buyer ratio. It's the turnover rate of the marketplace. You started off a quarter ago at 51 days. You're now at 53, so the number of days is roughly the same. But the market's improved because 13 weeks ago, it was 64% slower than it normally is, and now it's only 33% slower than it normally is. So the range is still pretty aggressive. You expect it to be between 27 and 47 days. So that's what I would consider a strong seller's marketplace. Around 40 days is where I start going from a strong seller's marketplace to a balanced marketplace. So you're 53, which is 32% greater than the 40, and that's just happens to be would be right at the cusp of a balanced marketplace. So you're taking 2 weeks longer, but that's still not a strong buyer's marketplace by any stretch of the imagination. That's what I'd call a balanced marketplace. Related to days unsold inventory, but yet a different metric, is the marketing time for 3 out of 4 sellers to sell. It's only 20 days, which is basically 3 weeks. And this was a quarter ago, which was 33% longer. But now look at where you were. You were between the gray line and the blue line. Very rapidly, you crossed over, and now you're significantly above the blue line. And that's increased to 36 days. So you've gone from 3 to 5 weeks for marketing time. You've gone from 33% slower than normal to 75% slower than normal. The longest you'd expect at this time of the year is only 26 days, and we're at 36. We're a week and a half longer than the longest you'd expect. But selling 3 out of 4 homes in 5 weeks is still a fairly fast marketplace from an objective point of view. So yes, it's slower than it normally is, but it's still reasonably quick. Price reductions. A quarter ago, you were taking 0.9%, which was 3 times greater than you normally are, which is why you're below the blue line. Right now, you're only taking 50%. You're taking 1.6, so you're doubling the magnitude of the price reductions. But compared to normal, because the number of price reductions increases, it's only 83%, so not even double what it normally is. Yes, the rate of price reductions is still higher than it normally is, but it's getting closer to the gray line. In other words, the distance from no price reduction to the gray line is triple here, and now it's only essentially double over here. And in large part, that's not because the purple line's improved. Purple line's actually gotten worse. It's gone from 9/10 of 1% to 1.6% price reduction. But the reason it's improved is the market normally slows, so there's normally more price reductions at this time of the year. This is sort of almost the time of the year with the maximum price reductions because this gray line probably bottoms out right in here somewhere, so a couple more weeks. Overbidding, on the other hand, is just a direct comparison. A quarter ago, we were at 7.7%, so we were 0.3% above the 7.4% overbid that you'd expect. But now that's dropped to 3.9%, so the overbidding magnitude has dropped almost in half, and it's now below where you'd expect it to be. You'd expect it to be 6.5%, so it's basically 2.6% less overbidding. And again, this is just an absolute number. When you're taking a percentage of a number around 100, it's almost one and the same, but I thought it was less confusing to do a direct comparison versus a ratio. Now we're looking at three key components over a long period of time. We're looking at inventory. Inventory in the purple line down here is almost back to normal. It's just slightly above the 100% gray line here. And the dotted lines to show that, yes, you have more inventory than we did in 2023 and 2024, but way less inventory than we did earlier this year. And it's sort of interesting. I'm getting inundated where I live with flyers from some other real estate agents that they're talking about the huge amount of inventory out there giving buyers a lot of choice. Well, that was true 6, 7, 8 weeks ago. Right now, we have absolutely normal level of inventory. So it's sort of interesting on how out of sync advertising tends to be with market conditions. Then moving on to offers accepted. This is the real key. Basically, all the way back here till sometime about fourth quarter of 2022, we've been running roughly 75% of the offers that we should be. Yes, it got all the way up to 88% back here, and it's gotten all the way down to 68% here. But when you really look at that, that's probably somewhere between 75 and maybe even 78 or 79%, somewhere there. It's below 80% for the average, but it's somewhere in that range. So we're missing between 20 and 25% of the volume of the market that we typically have. And because we're lacking that volume of offers, your days on unsold inventory is up here and slower than normal and almost slower than it's ever been on a percentage basis. So for the time of year, the market right now is turning over. The buyer turnover rate or the transaction turnover rate, the DUI number is, significantly slower than it normally is. It's basically a third longer than it typically is for this time of the year. And again, you can see by drawing the line back, the only time we were slower was earlier this year and brief periods of time during the COVID shutdown, a little period of time here in 2023 after the 2022 price correction. And also we had a little bizarre price slowdown in 2018. And that was after 2017 had 2 cycles of appreciation. Normally we have an appreciation cycle early in the year, January, February, March. And then we had a second one in August of 2017. So 2018, buyers went away, and that's why the DUI went way up. Looking at inventory compared to normal for Silicon Valley. So this is 3 counties, Santa Clara County, San Mateo, and Alameda County in a blender. You can see we had this significant improvement or drop in inventory. So we were up here at almost record high levels of inventory, and then we dropped down and we're getting pretty close to the normal level. We're still slightly above, and it's the vertical separation. So it's the vertical separation from the point here on the gray line to the point here on the purple line. Here you can see it on a percentage basis. You're somewhere probably, that'd be about 2% more inventory than you typically do. So not very, for all intents and purposes, it's normal inventory at this point. Here's the offers accepted. This again is the real story. You can see the purple line's right on the blue line right now and has been for several weeks. The general trend is we've been on the blue line basically all the way back here midway through 2022. So midway through 2022, we lost our transactional volume. We lost it in second quarter of 2022. You can see we were up here at record high levels on the red line. We dropped down, we crossed over the gray line. And then before the end of second quarter, we were on the blue line, and we've been there ever since. So basically, we're approaching our third full year, missing 25% of the marketplace as far as the volume of transactions. Here's it on a percentage basis, and you can see that slowdown in 2021 and 2022 with the price corrections that we went through, and then the flat line for the last 3 years. Here's the days of unsold inventory, so the speed of the marketplace. So you can see we're up here, and if I drew the line back, we're basically at record high days of unsold inventory. So even though 54, 53 days, whatever the number is still a fairly quick pace marketplace, it's far slower than Silicon Valley has been basically for the last 10 and a half years. Yes, there's little spikes here right after the first of the year where it was higher. COVID was higher with the shelter in place. So 1, 2, 3 years, it was higher for a very short period of time plus COVID. So 4 times we've had a slower marketplace than we have right now, but we're still moving around. What's interesting is we've yet to see any significant price declines. They may be coming, but we haven't seen them yet. Here is the days unsold inventory versus typical. You can see we're about 132%, so 32% slower than we typically are on a percentage basis. The only time that was slower than this of any duration was just earlier this past quarter. The past 13 weeks have all been slower. You can see there's been a fairly significant improvement in about the last 7 weeks, 8 weeks. Here's marketing time. It's related, but a different metric. This is the time that it takes for 3 out of 4 sellers to sell their properties. What's interesting is there seems to be a horizontal time shift where this peak happened halfway through first quarter consistently for the past 10 years. This year, it happened right at the end of the year and probably even 1 or 2 weeks into the 2024. And then the shift from the bottom to slowing down, instead of being midway through second quarter like it typically is, was midway through first quarter, and it's just been slowing down, and the slowdown is actually steeper than the gray line or steeper than the blue line, and so we're getting further and further away. So, when you read the time frame, you're basically up here at 36 days to sell the properties, and again, for 3 out of 4 sellers to sell in 5 weeks is pretty reasonable, but typically for Silicon Valley, you're down here at like 18 days. So we're twice as long as we typically are for the marketing time. Here it is on a percentage basis. And you can see that just a couple of weeks ago, we were actually higher than COVID. And there was a few weeks ago, I had to raise this chart up from 170% up to 200. And, yes, we're coming back down, but we're still over that 170%. I did truncate the COVID because it was so short-lived. And look how dramatic this has changed since midway through first quarter of this year. Here's the sellers that are taking the largest price reductions. Right now, they're taking about a 14% price reduction, which is about the most you'd expect them to do. Typically, they're only taking about an 11% price reduction, so 3% more price reduction than typical. Here it is on a percentage basis. So you can see that there have been times when we take larger price reductions. That typically happens after a price correction. So in 2022, we had a significant price drop, and sellers take time to adjust for those price changes, which is why there was the huge increase here. That we sort of had the same pattern here, but the magnitude is nowhere near as much. Here's the seller's average price reductions. I include this just to show you I'm not playing any games. It's a 1.6%. The reason this number is so much smaller is the vast majority of the sellers, typically less than 20% of the sellers, do price reductions. Right now, it's probably about 25%. Here's the compared to normal. So when you're comparing the same time of the year, you're still taking more price reductions now than you typically do for this time of the year. Here's the frequency. So how common are those price reductions? And right now you can see 22% of the sellers are doing price reductions. So that's pretty close to that 1 in 5. It's between 1 in 5 and 1 in 4 sellers do any price reduction at all. Everybody else is doing their homework, putting their house on the market at the right time, and selling without adjusting their price. Here's comparing everything to normal, so seasonally adjusting it, and you can see that we're basically somewhere around 50% more price reductions than normal. So the frequency right now, I said I think it was at 22%. So I think if I did my math right, it would be about 15%. So half of 15% is 7%, and that would get you up to the 22% that we saw. So normally you have something like 15% of sellers doing price reductions, and right now it's 22%. Here's the overbid. This is the median versus the average. The median is down here. It's something like 1% overbid. So the number we quoted earlier, which I forgot what it was, maybe around 3.9%, that was the average overbid, which is going to always be higher than the median overbid. This is the point where half the buyers are bidding more than 1% above the seller's ask price, and half the buyers are bidding less than 1% over, including those that are bidding under the ask price. Here's the typical. So you can see we're now below the typical level of overbidding as far as the magnitude, and we're about 2.5% less overbidding than we typically get. You can see that just a quarter ago, now this is almost 2 quarters ago. Yeah, 2 quarters ago, we were about 4% more overbidding on magnitude, and now we're about 2.5% below. So that's a shift of 6.5% right there in overbidding. Here's the frequency. You can see that we maxed out this year at something like 74% of the sellers getting more than their asking price. we're now down to 56% of the sellers are getting more than their asking price. So it's still over half the sellers are getting more than their asking price, but it's also right on the blue line, which is the least amount of frequency of overbidding that we'd expect. Here it is on a percentage basis. You can see that last year, 2024, we were pretty much up here somewhere around 5% more overbidding on a frequency basis than you'd expect. We started to go up at the beginning part of this year, and then we just did this huge straight correction, going from basically 15% more overbidding than typical down to a number now where it's 20% less, and this is the frequency. So that's a shift of 35 percentage points. Here now is two price models on log paper. One way you could look at this is we've done an 11.4% rate of appreciation over the last 10 and a half years, or more realistically, we went up 12.1% for about 7.5 years. And for the last 3 years, we've been basically at a 0% appreciation. Yes, if you bought up here, you'd be upside down compared to the price, but you'd be make a huge profit if you bought right here at the bottom. So there's the cycle from month to month, from week to week. But when you start looking at this annually, it looks like the median price really isn't changing very much. Here now we're looking at 3 sets of distributions. The first one is days on marketplace. This shows not every transaction, but we start at 50% of the sellers. And this is why I don't like the median, is there's very little separation down here at the median, because the median is the 50th percentile. When you come up here to the 75th percentile, now you can start seeing the market's quite a bit slower. And you get up here to the 80 to 85%, and the gradient is even more significant. We're starting off on the dotted line, which is a year ago. The purple line is the current year. So we're clearly quite a bit slower. Slowest up here, the longest marketing time. So we're taking longer to market properties than we did a year ago. And we're going to step through, because the direction of the first couple lines right there, which really isn't moving very much, is what you'd expect the purple line to do. So based on track record, you'd expect the purple line not to really shift that much. So you're just seeing how common and stable the market is. Now it's starting to slow down. It's slowing down. There's the peak of the marketplace on the longest on January 3rd of 2025. Then it starts accelerating fairly rapidly. There's the bottom of the market on March the 1st of 2025. And then it starts slowing down ever since March 1st. And somewhere right about there is where we were last year at this time, but you can see that we've continued to slow down past that and taking longer times on the marketplace. And here again is current time frame. So right now, 80% of the sellers are taking 40 days, 90% of the sellers are selling in 60 days. Keep in mind, this only counts the sellers that are successful in selling. We're having more and more sellers now that are coming on the marketplace, not selling it, and going off the marketplace without ever selling. And they are not included in marketing time. They are included in days of unsold inventory. Now we're doing the same thing on price reductions. This is the largest price reductions. And when I say the largest, it's basically a 15% swag of the marketplace. I ignore the top 2.5% of the sellers that are taking the absolute largest price reductions. Sometimes that's data errors that sneak through. Sometimes that's just fluky situations and things like that. And I also don't go past 17.5% on the low side. And the reason I don't go below 17.5% on the low side is most of the time you're at 0 price reduction there. So just adding in a whole bunch of zeros just makes it harder to see that. Adding in a whole bunch of zeros just makes it harder to see the data trends. Stepping through, you can see there's not much change. We're sort of in the stable summer time frame right there. We're getting into September, October. Halloween's approaching. It's starting to slow down. Thanksgiving's approaching. It's really slowing down as Christmas approaches. There's the bottom of the marketplace. And then it starts to improve really rapidly. There on March the 1st, and also again on March the 15th, they're tied for the fastest or the least number of price reductions. Now we're approaching current time frame. Look how much those are dropping down. And now when we get up to the current purple line, notice that it's basically the coolest line on the whole thing. Right there is your purple line. There's no lines behind it. So right now, the sellers are taking more price reductions and more frequent price reductions than they have in the last 52 weeks. And so in the past year, right now is when the most price reductions are occurring. And here's the third and final distribution. This one is on overbidding. So this is delayed by 3 to 6 weeks as we need to get the sold price. And when the market slows, it's a longer period of time. So right now it's probably getting delayed by about 5 weeks. we can see the purple line is the least amount of overbidding of all the lines on here. The current line's up here a year ago. So a year ago is when we almost had the most overbidding. And currently, we have the least amount of overbidding. Let's step through and see so normally the pattern goes cooling. So even though we're already at the cooling spot on the purple line, I'd expect it to cool going forward. It isn't until about October that this sort of does stabilization. Remember, the other was stable in the summer. This is going to be more the fall because the time lag. Now you're cooling off for the end of the year. There's February 14th, Valentine's Day of 2025 was the least amount of overbidding, but then that's delayed. This is the most amount of overbidding. That was March 15th, and it's really stabilizing, and then it jumps down fairly rapidly, and we're going to end up on the purple line, which is the worst line on there, except one more right there. You can see there's a little bit of a line right through here that goes below it. But right now, we basically have the least amount of overbidding that we've had in the past year. Now what we're doing is we're comparing the three counties, San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. Alameda County is basically back up to the level of inventory it typically is. San Mateo County is basically at record high levels of inventory, so setting new record highs, and Santa Clara County is still below where it used to be. So only Santa Clara is locking in inventory right now. But when you bring up the whole Silicon Valley, they only are slightly more than normal. Here's offers accepted. Alameda County and Santa Clara County have essentially the identical number of offers being accepted, even though Alameda County had significantly more inventory. And you can see the number of offers for the two counties really mirrors each other very well for the past 10 and a half years. And then you have San Mateo, which is much smaller in size. And even though San Mateo had record inventory, it does not have record high volume of transactions. In fact, it's basically down here at the record low that it's been at since halfway through 2022. So for 3 years now, San Mateo County has been missing a fair amount of transactions. Here's the speed of the marketplace as measured by days of unsold inventory. Alameda County is the slowest at 60 days. Keep in mind, 60 days is still fairly reasonable. Most parts of this country consider 3 to 7 months to be normal. That's 90 to 210 days. I do days instead of months because our numbers are so small. Talking about 2 months and then down here a month and a half really doesn't sound like much of a change. But when you talk about 45 days to 60, you can, sense, that you can relate to them. And frankly, it would have been better probably if I used weeks because there is a strong weekly cycle, not a daily cycle in real estate. But that's hindsight. San Mateo County is the second slowest county at 52 days, and the fastest county is Santa Clara County at about 47 days to sell all your existing inventory. Marketing time is going to be in the same order. Alameda County is the slowest at about 37 days. San Mateo County is next at 34, and Santa Clara is the fastest at 33. So they're all in the mid-30s is what I would call it. So that's still very reasonable. That's 5 weeks to sell 3 out of 4 sellers. Here's the magnitude of price reductions, very close together, somewhere right around 1.5%. Santa Clara County is about 1.4%. San Mateo County is about 1.6%. And Alameda County is about 1.7% of a price reduction. That's on average. This is the frequency of price reduction. So how common is it? Santa Clara County is right there at about 21%. San Mateo County is about 20.75%, very close together. Call them both 21%. And then you have Alameda County not far behind at 23.5% of the sellers doing a price reduction. So less than 1 in 4 in all counties, but more than 1 in 5. This is what the buyers overbid and try to secure the property. And this is average. Alameda County has the most overbidding, which is sort of unique. It's the slowest county with the highest, slowest turnover rates, longest days on market, and it has the highest amount of overbidding. What I believe is going on is sellers are going on the market, not being successful, reducing their price, overshooting where the buyers are willing to pay. The buyers then say that's a good value and come in and overbid the seller's new lower ask price. Then you have Santa Clara County next at something like 3.5% average overbid. And remember, the median was down around 1%. And then San Mateo County has the least amount of overbidding at 3% over the seller's ask price. Here's the frequency of overbidding, basically from 55% to 58%, very close together, all 3 counties in the same range. Here's the appreciation. San Mateo County down here on the orange and Alameda County in the gray are very close together at something about 75%. of appreciation since the last 9 months of 2015. Santa Clara County is clearly the highest at about 207% or 107% appreciation. I will point out one of the things that's happening in Santa Clara County is the expensive areas are making up a larger percentage of the market share. And if you go back and do a weighted average of each micro market area, which is going to give you a better idea of what property values are, this number drops from this 107% to 86%. That would be a much better comparison. So Santa Clara County is still outperforming the other two counties, but not by as much as this particular graph shares. And what this tends to do is a lot of people quote the median price. So they're quoting that the prices are still going up, but if this is going up because there's a shift in the market mix, that doesn't reflect property values. Here's the sold price. You can see Santa Clara County is now just under San Mateo County. I think San Mateo County is exactly 2 million and Santa Clara County is 15,000 under that. And then Alameda County is more affordable, about 1.3. While San Mateo County and Alameda County are below their 2022 peaks, Santa Clara County is right at their 2022 peak. But in order to see if that's really true, we'd have to go back and look at the market makeup and see if this number here, the number now is going to be lower. I said it would be, 20% lower, but what we don't know is what the market mix was here. Was it more typical or was it more current and skewed? So anyway, prices are basically flat since the 2022 peak, and they're really under the 2022 peak. They're really equal to about their 2021 pricing, and that would explain why this jump happened. This is maybe where the micro market mix happened, right through here. So if you drop the price down to here, that's about where Santa Clara would be now and below their 2022 peak. So that's on logarithmic paper, and then this is the same information on regular paper. You can see a little clearer here that Santa Clara County is just below San Mateo County. And here's estimated payments. I'm using the high balance conforming loan interest rate, which is going to overstate the payments. Also, if you put more than 20% down, your payments would be lower. It also includes property taxes and an estimate for insurance. Here now we're getting into the micro market areas. Here is the active inventory in the 20 different micro market areas in the Silicon Valley. And you can see in Santa Clara County, you have anywhere from a shortage in Cupertino and Sunnyvale of 68% of the normal level of inventory to a surplus down in South County at 26% more inventory. Silicon Valley overall is at 2% more inventory than you expect. Santa Clara County is actually missing 5%. San Mateo County is 28% surplus, and Alameda County is missing 3.5%. So you can see there's a change. Here's the shortage right here on the west expensive areas of Santa Clara County, and the surplus is down here in South County and Santa Clara County. Here's looking at the number of offers compared to the 10-year median, because just the number of offers doesn't really tell you anything. And that's why I compare these two only to the 10-year median instead of showing raw counts. But you can see that the offers are blue in color, which is significantly favoring the buyer. You can see Silicon Valley is at 75%. You can see Santa Clara County is at 76%, San Mateo is at 83%, and Alameda County is at about 73.5% of the normal volume of offers accepted. Here's days of unsold inventory based on the 10 years. So we're still doing the comparison. So days of unsold inventory, much slower than normal, 33% slower than normal, 27% slower in Santa Clara County, 46% slower in San Mateo County, with Redwood City, Foster and City being 200% slower, the San Mateo Coast 190% slower, the cities, which is the first major metro market area, 46.5% slower than normal. Alameda County, I only have countywide data, and that's at 30% longer than normal. Now you're looking at just the raw count. So even though the previous slide was fairly blue, the current slide, just raw numbers, is pretty red. And what are we talking about? We're talking about selling out the entire inventory in under just about a month, 32 days, 36 days, 36 days, 34 days, 23 days, 32 days. So clearly a quick pace marketplace, even though it's much slower than normal. Here's marketing time for compared to normal. So way longer marketing times than normal. For Silicon Valley, it's 53% slower than normal. Santa Clara County, 3 times what it normally is. San Mateo County, 2.8%. And then Alameda County, 2.8%. Here again is an interesting makeup. All three of those individual counties is somewhere very close to 300% or 3 times slower than it normally is. But Silicon Valley overall is only 53% slower. How do I possibly explain that? Again, I think it's the market mix. Since these are a percentage compared to normal, Silicon Valley, the fast areas are making up a larger percentage of the market share than they typically are, which keeps the total number down. The next slide may make a little bit more sense. So here, as far as raw counts, you can see that you're 33 days for Santa Clara County, and then you can see the makeup within Santa Clara County. San Mateo is 34 and 37. So county-wide, Silicon Valley-wide, saying 36 makes sense. Here's the magnitude of seller price reductions compared to normal. So we're taking a larger price reduction than we normally are by about 2.5% in Silicon Valley. While Silicon Valley is 3%, Santa Clara County is 3%, San Mateo County is 1.5%, and Alameda County is 4.3% more price reductions than we normally do based on the 10-year number. Well, that clearly favors the buyer, which is why there's so much blue. But now when we move on and look at the actual just raw numbers, these are favoring the buyer, but they're still very small numbers. 1.6% price reduction, that's fairly insignificant. 1.4 for Santa Clara, 1.6 for San Mateo, and 1.7 for Alameda County. So Alameda County is the most price reductions, balancing out Santa Clara that has the least. And again, each micro market area is listed individually, but the blue color tends to favor the buyer. So here's the frequency of price reductions compared to the 10-year normal. You can see that Silicon Valley is doing 33% more frequent price reductions. The Morgan Hill, the South Coast, is actually doing 8% less. The area that's doing the least well is Los Altos, Palo Alto at 53% more price reductions than normal. In San Mateo County, you're at 21% more than normal price reductions. The area that's doing the best is the Bay Cities, San Carlos, Belmont, San Mateo, Burlingame, that area and through there, all the cities. They're at 2% less than they normally do. But then you have areas like Pacifica, 65% more than normal. The expensive areas at 23% more than normal. Redwood City at 41% more than normal. So a huge difference right now between Redwood City and the Bay Cities. In Alameda County, you're at 65%. You're going anywhere from Oakland, where they're doing double the price reductions as far as frequency, to Fremont, that's right at normal at 3% more than normal price reductions. This is just the raw numbers. On a raw number, you're basically looking at only 22%, between 1 in 4 and 1 in 5 sellers are doing a price reduction. So even though it's way more than it normally is favoring the buyer on the previous slide, the numbers here are still pretty reasonable. The highest number I'm seeing anywhere is 31% in the expensive areas in San Mateo County. So basically less than 1 in 3 sellers are reducing their price anywhere in Silicon Valley. Here is the overbid, and this is compared to normal. So you can see that buyers are overbidding significantly less than they normally are. The only area where they're red at all is in Los Altos, Palo Alto, where they're basically right at normal. So I'm not sure why. That's actually 2% more than normal. So that is actually aggressive overbidding, because this is on a full percentage basis. But then you get out in here to Livermore, and Livermore is, where's Livermore? Livermore is at 3% less than overbidding. You go down to Oakland and it's 4%. That just shows you basically what happens in real estate is typically buyers don't go in and offer sellers way less than their ask price. They wait for the sellers to reduce their ask price, which is why I go saturated blue at 90 with a 3% price reduction, which is really pretty small. And that's 3% less than the seller's ask price. So if the seller's asking $1 million, you go in at 970,000, that's a 3% reduction. This is the average overbid magnitude. So you're anywhere from Silicon Valley at almost 4% overbid. You have a low somewhere, I think there's probably a negative number. Yeah, Pleasanton is minus 2.2% reduction. The expensive areas is 2.3% price reduction. And then on the positive side, you go down here to Berkeley and the city of Alameda, and they're 16.5% over the seller's ask price. So they're by far the highest. After that, you have Oakland at 9%. Those two are by far the highest. Then you jump down to something like San Carlos at 5%. So pretty major drop from the two highest that are both in Alameda County. This is the frequency of overbidding. So how common is overbidding? And this is compared to the 10-year median. So you can see that overbidding is way less than it normally is. It's, for Silicon Valley, it's 80%, 20% less overbidding than normal. And this is frequency. So if You normally have 80% of the buyers overbidding. You only have 64%, I think, if I do my math right. Here's the frequency of the raw numbers. So even though it's favoring the buyers, it's still over. Well, half the buyers give the sellers more than they're asking, or half the sellers receive more than they're asking for their property. So even though it's favoring the buyer, overbidding is still common. Here's the long-term appreciation. This is what I mentioned earlier. Santa Clara County has 107% appreciation. But if you look at all these numbers, no one micromarket area is even at 100%. The highest one I'm seeing is 91.5%. How do I explain that? What's happening is areas like Cupertino, Sunnyvale, even Campbell and Saratoga, Los Gatos, and Los Altos are making up a bigger percentage of the total market. And so they're above the median price for the whole market. So that raises the median price. If you did a weighted median, which would be more accurate to the property values, this 107% drops to about 86%, which is more in line with San Mateo County at 74% appreciation and Alameda County at 72%. So even though Santa Clara County has had the highest appreciation, it is not, property values have not gone up 107%. They've gone up closer to 86%. And that's just a ballpark. What you'd want to do is look at the appreciation in each one of the micro market areas. And you can see that some areas are, well, the highest is 92 and the lowest is 67. So that you can see how 86 is a reasonable approximation. Actually, you got a 95 here in Milpitas, almost a 96. Here now is the price. Instead of following the median number, which is the middle number, I also sandwich it with the cheapest 10% on the left and the most expensive 90% on the right. So you can get a price range in each one of the micro market areas. Here, the red is simply showing you where the expensive areas are, and the blue is showing you where the inexpensive areas are. Here is a summary of what we just went over. And again, you can see that inventory over here is basically normal. You got a couple areas where it's less inventory than normal, a couple areas where you have more inventory. So inventory now is basically normal for Silicon Valley. But compared to normal market conditions, we have less offers. We have a slower turnover rate. We have a much longer marketing time. We have larger price reductions. We have more frequent price reductions. We have less overbidding, and we have less frequent overbidding compared to the 10-year median. But when you come over here and look at the numbers, except for price adjustments, your days unsold inventory is still fast, selling out your entire inventory in 53 days. Your sellers, 3 out of 4 sellers sell in 36 days. Your price adjustments, only 1 in 5 sellers reduces their price. Buyers are overbidding 3.9%. And more than half the sellers are getting more than their overbid, and we've had roughly 90% appreciation. That speaks volumes for how hot Silicon Valley typically is. So yes, we're not as hot as we normally are, but we're still respectable based on any reasonable benchmark. So it's an opportunity for buyers to get out there and buy with less competition, but it's still a competitive marketplace. Here's the volume of sales chart that I've been putting up. We're the second least. The only year that had less than this for this past week was 2023. We're pretty close on some of these other numbers. We would, we lose another 8 transactions for last week, which could happen with transactions failing. We'd become the second worst year. So basically, for the most part, we've been in the second worst year for a while now. The one that we won't beat is this one. This is going to be in the second worst year. And out of 10 years, that's not so striking, but it's also out of the last 25 years, and that's where it becomes more significant. Here now is a table, a summary. You can see Silicon Valley, Santa Clara County numbers, San Mateo numbers, and Alameda numbers. Each one of them, you can look at the metric. Here I boxed out the different median days on marketplace. You have the median, which is still very respectable, just basically 2.5 weeks. The average is basically somewhere around 4 weeks, and the 75th percentile, it's around 5 weeks. I like the 75th percentile. Inventory is starting to drop across all regions. Normal peak inventory is around July the 19th, and that's basically when we had peak inventory this year. So inventory is going to drift down probably most likely for the balance of the year. We've been talking about the Silicon Valley real estate marketplace. We will talk about the greater Bay Area, 13 counties and 5 regions. The YouTube channel is here at Silicon Valley Real Estate Market to the YouTube channel, or you can type in the shorter green root URL. To get to the live presentation Saturday morning at 9 a.m., you type in the green root URL 2025, and it takes you over the Zoom meeting, or you can get the Zoom meeting in the handout, the link if you want. Don't trust secondary links. If you want the handout, green root URL, the letter H for handout, 2025, 07 for the month and 26 for the day. And the handout is posted. It was posted for last week as well, even though the video for last week never got posted. And if you want a specific episode without going to the YouTube channel, you just type in the green root URL, the year, month, date code. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. So reach out to me if you have any real estate needs. Here are the 5 regions that we're going to be talking about. You have the Silicon Valley we've been talking about, the cities, San Francisco and Marin, North Bay, the 4 counties, Central Valley, 2 counties, and Central Coast, 2 counties. Here's active inventory. You can see Silicon Valley rolled over. You can see that basically most of the regions have rolled over. Central Valley is still climbing. I would say the other 4 regions have rolled over and are going down on inventory. Here's our offers accepted. Silicon Valley peaked and has gone down. The others aren't so much. North Bay did a huge spike up in number of offers just last week for some reason. Central Valley has been climbing. The cities have been going down like Silicon Valley, and the coast is its own little animal, but fairly flat. Way more stable, but also a smaller region. Here's the days of unsold inventory. You can see Silicon Valley is the fastest. Cities is the only one that's closed. And by the fastest, we're basically somewhere around 53 days. Cities is somewhere around 62 days, maybe 64. And then you jump all the way up here to 85, 90, and 95 days. So some of the areas have quite a bit longer, but if you go back in time, you can see that it's only purple, only Silicon Valley that has the really fast turnover time. Here's marketing time. Again, Silicon Valley is the fastest of the group. They're all climbing. There's been a little improvement in the coast and in the North Bay for this past week, but that could just be statistical fluctuation. You can see that happen in the coast back here. In general, I would say they're all increasing. Ask price reductions, they're all going down, which is increasing, except notice in basically this last week or two, all of the regions have basically plateaued out. The Central Coast is flat, North Bay's decreasing. I guess Central Valley and the cities are probably flat, and Silicon Valley is flat. So flat on the additional price reductions. Frequency of sellers' price reductions, most frequent in the Central Valley with just over 40%. So what would that be? 2 in 5 sellers are reducing their price. The least common in Silicon Valley at 22% of the sellers are doing their price reductions. Quite a bit of a range, almost a doubling in the range from between Silicon Valley and the Central Valley. All of them are increasing. So it's more frequent seller price reductions. This is the amount of overbidding. So this is a lagging indicator because you need sale prices. They're all going down. So buyers are starting to sense that they don't need to overbid as much. And the frequency of overbidding is also going down in all 5 regions. Here's the appreciation that you can see the cities has done the least well. We talked about this is Silicon Valley at 90%. The other one was the individual counties at 107% for Santa Clara County, and that would be closer to 86%. So these are still being impacted by market mix. But you can see the appreciation is anywhere from 50% appreciation, or actually closer to 47% appreciation in the cities, which is clearly doing the least well, up to basically almost 95% appreciation in the Central Valley. Here's the long-term pricing. You can see that prices have been basically flat for the last couple of years in all the regions, and you can go back to different time frames. When did we first hit this peak? Most of the regions hit the peak. Well, North Bay cities hit the peak back in 2021, or hit the current price level. All 5 regions hit it by 2022, and they've been basically flat ever since. Yes, there's fluctuations with Silicon Valley and the cities having the most fluctuations, but overall, the trend, there isn't much appreciation since somewhere right around in here. Where you draw the line is up to you. Here's the payments, which are going to be in the same order as the purchase price. Central Valley is the most affordable. The cities is currently the least affordable. Silicon Valley is the second least available. If you wanted to jump these 2 together, that'd be fine. Central Coast is in 3rd place, and the North Bay is in 4th. And obviously, I already said Central Valley is the most affordable. Here's the raw numbers for each one of the counties over here, all 13 counties. I also have all the 5 regions in bold. I also add in just regular text, the Bay Area. I do this because the media talks about it, but I believe it's a garbage number. There's no way to have one set of numbers describe what's happening. You can't even have one set of numbers describe what's happening in a county. Then I do a percent change from 1 week ago and a percent change from 5 weeks ago. And with that, we're back to the chapters. You can jump to the YouTube chat section that you like the most or watch the whole video. I do appreciate likes and subscriptions. Reach out to me with any questions, suggestions, improvements, or if you have a real estate need. Thanks for joining. Take care. I'm again Richard Calhoun with Creekside Realty, real estate broker representing buyers or sellers here in Silicon Valley. Thanks. Have a good day. Bye now.